Welcome to Investors Insights. Our topic today, market returns and Fed policy. We've got several clients asking questions about the markets as well as about interest rates. And we wanted to make sure we address that this morning on our blog. So starting off here, I just want to introduce my distinguished colleagues, as I like to refer to them, because they work really hard and do incredible research on our portfolio strategies team. Bobby Norman, Trey Booth, and Ty Miller. I always look forward to our meetings. You guys really energize things in terms of new ideas and concepts and trends out there. Bobby, you started us off this morning in terms of yields, treasury yields. So talk to our viewing audience in relation to how that can impact portfolios.
Yeah, so we're watching interest rates carefully at the current levels as equities have seen a small drawdown over the past few weeks amid a mixed earnings season and then also increasing interest rates. However, it is important to keep in mind that yields are approaching levels that created trouble for equities in the past. And so we're looking at this carefully. So looking at this chart, we are well above the March 2023 levels when there was a bank failure. But we're still below the October 2023 levels when the market corrected. So you can see that rates have spiked higher since January as inflation has continued to come in higher than expected. One reason this is concerning for the markets is the interest expense has turned up notably for corporations. And should profits start to falter, that is when the bigger issues will turn up. So it's no secret that higher rates negatively impact profits, which can hurt market returns. And so we will continue to watch rates carefully at these levels to see if adjustments in our investment strategy need to be made.
Yeah, no, those are excellent points. Too often, and we have some clients, they'll go, well, I'm focused on interest rates for CDs and mortgages and those type of scenarios, and don't understand fully how that relationship between interest rates, Fed policy can impact the overall stock market and other markets as well. So Trey, you elaborate even more on what Bobby was saying in terms of markets and Fed policy. Talk about that.
Yeah, thanks, Greg. So last week, the Federal Reserve met and made their decision. So each time the Fed meets, they can make one of three decisions. They can hike rates, which is considered restrictive. As Bobby pointed out, higher rates can reduce profits. They can cut rates, which is stimulative, or they can do nothing. Last week, they decided to do nothing, which after the Fed hikes rates, when they stop, that's considered a pause. And so the Fed decided to continue their pause. And so now we're 280 days into the Fed, what's called the Fed pause. And that's the second highest pause on record. You can see in this chart in the past, pauses, and we've been talking about this since last year, pauses are generally good. Coming into this year, the market expected rate cuts. We didn't think rate cuts would happen, and we didn't think cuts would be good because it's not that the Fed cuts rates, it's why the Federal Reserve cuts rates. And if the Federal Reserve is going to cut rate, that's an indication that they have to because the economy is slowing. They have to stimulate something. And so a pause is kind of not too hot, not too cold. And the market really likes that kind of balanced approach because interest rates aren't too high and they're not too low. They know what they're expecting. It's kind of set. And you can see that over time, traditionally, pauses are positive. The rub is this: we're in the second longest pause. The longest pause was 2006, 2007, and that did not end well. And so it's not just that the pause stops, it's why the pause stops. And that's what we're watching closely. If interest rates get so hot, to Bobby's point, where corporate profits are harmed, we start to see earnings drop, we start to see spending drop, we start to see the economy really slow into a recession, which would cause inflation to come down, then the Fed would have to cut rates. And that is not a good reason to cut rates. That is not a positive scenario, but that's what kind of started to happen in the 07, 08 area.
Yeah, and we're watching all this closely. We've got tremendous research here and having debate, discussion, and also looking at our clients' financial blueprints in relation to their portfolios. So great insight there. And Ty, you brought up the fact we're already 4 months through this year. We're at the end of April. And talk to us about that in terms of being at the end of April and market returns.
April obviously was a down month. We kind of all felt it, all saw it. But that ended a streak of 5 consecutive positive months for the S&P. This doesn't happen often, as you can see in this chart. Only happens, a couple handful of times here. And And so usually when that streak ends, however, it's one of two things. Does the market kind of go down or does the market recover? So people always wonder, is this a start of something new? Well, that trend kind of reverses usually. In fact, 100% of the time, again, past results don't mean this is going to happen in the future. But we usually get some good returns 1 year out from when this 5 consecutive, positive monthly return streak ends. So that's something we're going to keep an eye on as we turn here to May, which typically is, not the best of months either. And then also in April, one, somewhat concerning thing is utilities were the only green sector. So the market's, broken down into sectors: utilities, energy, tech, healthcare. Utilities was the only one up. And so that's unusual because
and that signifies the color green, correct?
Correct. Yeah. And then everything else is in red here. And so that's, a little unusual because utilities usually aren't a leader unless, we're in a down market. And then with rates up, usually utilities are kind of performing against rates. And so rates up, you would expect utilities down, but that wasn't the case this month. So it's something we want to keep an eye on. You would prefer to see some of the more growth areas like tech and financials and communications lead. And so that's something we're gonna keep an eye on as we move forward.
That's excellent information. And the reason I mentioned that about green, if you come to Five Plan Partners, our screens, everything that's going up for the day is in green, and everything that's maybe down is red. And so we use those color codes all the time here at Five Plan Partners because we can glance at the screens and see what's going on. So great information. We hope our viewers have thoroughly enjoyed this. It's given you great insight to understand in relation to the other news media that's out there, what the impact is of interest rates and corporate earnings. We'll keep you updated as well throughout the week through our social media, LinkedIn, Twitter, Facebook, our podcast, our YouTube. We're wanting to find every way possible that's convenient for you to learn as well as keep you updated. We hope you have a great week. Welcome to the month of May. And we're going to keep you informed through all of it. Every day striving to see to it that our clients' lives are better, richer, fuller. Take care. Talk soon. Thanks.